Right, good afternoon, everyone. People are still joining the call now, but just like to welcome you all to the first of the year, first of our series of webinars on the UK economy, first one of 2022. Also, we had three last year, and hope to have a few more this year. I'm delighted to again be joined by David Smith, obviously economics editor of the Sunday Times since I think 1989. If I'm right, also author of numerous books and also a visiting professor at Cardiff and Nottingham University, and I'm sure he's well known to all of you, particularly with his column, weekly column in the Sunday Times. So just to remind you on format, David's going to speak and run through a presentation for about 30 minutes, obviously mainly focused on the UK economy, but some areas a bit broader than that. And please do. We've had a number of questions that people have sent in. We'll cover those at the end. But if they're relevant at the time, as David's running through things, we may do some questions along the way if that is okay. So if you do have any other additional questions, please just put them in the Q&A slot, and we'll try and get to as many as we can towards the end. Anyway, on that, I will now pass over to David.
Thank you very much, John. It's a pleasure to be joining you again for this webinar, and thanks for everybody who's joined it. I suppose that by this time, we did one of these nearly a year ago, and I suppose by this time, many of us would have hoped that these things would be in-person events again. But these webinars work pretty well, I think, and they're fun to do. The news is of course, none of us have lived through anything, I don't think, as unusual as over the past couple of years. Certainly I haven't. And, lockdowns, easing of restrictions, lockdowns and so on. And the economic numbers, and some of them I'll come on to in a second, have also been pretty staggering. So, unprecedented economic numbers. So it's been an unusual time, and hopefully in a year's time, we will be able to do everything we want to again. But let me just run through a few things that I think might be relevant to you, and then we can. I look forward to your questions. I look forward to the discussion via John. So, what are the prospects for? We're still quite early in the year. What are the prospects for 2022 in terms of the economy and the housing market? Was what I wanted to address today, and I thought I'd do that. On the understanding that asking yourself questions is always easier than taking somebody else's. I'll try and answer four questions. The first one is the recovery well based? Has it been knocked off course by Omicron? And of course, now we're seeing the restrictions for Omicron being lifted, which is good news. So question is, what about the UK recovery? Has it got legs? Inflation is the issue of the moment. And we saw just yesterday, inflation rising to a three-decade high of 5.4% on the Consumer Prices Index, and pretty scary 7.5% on retail price inflation. So this is again territory that not many of us have seen in recent years. I mean, John mentioned that I've been economics editor of the Sunday Times since 1989, and that was the point where we were just moving into a short period of higher inflation. At the end of the 80s, early 90s, we got back into double-figure inflation, but I'm old enough to remember much higher inflation rates than that, nearly 27% in the mid-70s, and again going up to 22% in the early 80s. So inflation is the big story of the moment, and how is that going to pan out? Tax hikes, 2021 was a huge year for the announcement of tax increases, but we haven't seen any of them implemented yet. The first tax increases really don't start to come through until April. Is that it? Will all those go ahead? And could there be even more because of the state of the public finances? And I suppose one of the more surprising things, may not have been a surprise to you, it was to me, that we saw this boom in the housing market pretty quickly set in after the pandemic broke. So you'll remember the period in the spring of 2020 when the housing market was closed, and it looked as though this was going to follow a normal recessionary pattern. In other words, recession hits, housing market is hit quite hard. But we didn't see that. So, and instead we've seen a pretty strong revival. And I'll come on to whether that revival can survive the removal of some of the stimulus that the housing market had in terms of stamp duty, in terms of extremely low interest rates. So those are the questions. There's other things you might want to talk about. You may have heard enough about Boris Johnson, but some of these other things, you know, supply shortages, which have been with us for quite some time. You know, if you try and order a new car now, you're told that the waiting list is perhaps 6 months, maybe longer, which is something we haven't seen for quite some time. State of play in terms of the EU, the cost of going green. You know, I think the next big battle, either for Boris Johnson or for his successor, is whether he can keep the Tory party on a kind of net zero path. You know, there's a lot of resistance to that within the Conservative Party. Business rates, are we ever going to see them properly reformed? And the question, you know, we'd all want a high wage economy, but can you have that without a high productivity economy? Those are some of the things, other things we might talk about. But anything you like to talk about, I'm happy to do. On the first one, you know, the global economy, I think, is doing pretty well. I mean, you'll notice two lines on this chart. The top one is what this particular organization, the OECD, the think tank, the price-based think tank, expected if there'd been no pandemic. You see that blue line going straight across there, and the other lines are what it now expects. And as you can see, the trajectory is not that much different. In fact, it's slightly steeper than it was then, which shows that the damage from the pandemic is being undone at a global level. Quite a few countries have already, you know, China got back to pre-pandemic levels of GDP pretty quickly, did so during 2020. America did at the beginning of 2021, and other countries are doing so. You know, we've still lost the growth that we would have had in 2020 has been lost, and maybe lost forever. So we will be, there is a hit to the global economy as a result of coronavirus, but it is perhaps not as big as people feared when this thing first hit. And if we look at the UK, I mean, there was good news in the latest. You know, we're lucky enough. You know, monthly GDP figures, gross domestic product, didn't exist until relatively recently. So it's been great that we've had these during the pandemic, because it's been a wonderful opportunity to you know, to assess where the economy is going on a month-to-month basis. And you see you know, the hit to the economy in the spring of 2020, something we've never seen before. The economy shrunk by nearly 20% in the second quarter of 2020. Previous biggest quarterly fall was about an eighth of that, you know, so less than 3%. So that was a hell of a hit. Then we saw a bounce as restrictions were lifted, and you know, this year, sorry, in 2021, we saw that after a smaller hit, you know, one thing we learned about lockdowns was that we got better at handling them. You know, maybe we got used to working from home. Maybe we adapted quite well to living with lockdowns. And the subsequent hits to the economy from lockdowns 2 and 3 were actually quite mild compared with the first one. And the good news is that even if the Omicron has taken a little bit out of the economy in December and perhaps this month, then we did get back to pre-pandemic levels in November. And just to put that in context, you know, normally it takes 3 years to get back to where you were before a recession. That is the usual pattern. After the financial crisis, it took 5 years. So this one that's been achieved in 2 years or less just shows how unusual this recession and recovery was. You know, mainly, you know, caused by restrictions and changes in behavior. People change their behavior voluntarily, but big hits to economic activity, but subsequently less big hits. If we look at, you know, where business confidence is, it's been a bit, you know, it should have improved, and it's too early to get the results of that with the lifting of restrictions. But business confidence has been a little bit fragile. You know, this is one from the Institute of Directors. You can see that it was fragile even before Omicron. And I think that is a reflection of, you know, some of the things that were going around, including what I'm about to talk about, which is the increase in inflationary pressures. And similarly with consumer confidence, you know, I'll break an embargo by telling you that the next set of consumer confidence figures on this particular measure which is done by a firm called GfK, are out tomorrow. And they also show that in January, things have weakened again. Pre-restrictions being lifted, maybe before people realized that the Omicron wave was subsiding. But again, consumer confidence, we not as weak as it was at the low point of the pandemic, but a little bit down in the past 2 or 3 months. So consumer confidence somewhat weaker than it might be. So all those are, and why is all this happening? I think Omicron was even if Omicron has turned out to be milder than was initially feared. I suppose just the fact that there was another wave, we thought we were getting through it, another wave comes along. There were initial doubts about the effectiveness of vaccines. And we don't know, of course, we hope that this is the last one, but the scientists tell us there may be other variants but we hope that subsequent ones will also be milder. But that increased the uncertainty over COVID at a time when I think we were getting towards that thing about living with it. Supply and labour shortages, again, something that are causing problems in many sectors of the economy. And the factor of labour shortages, we've still got nearly 1.4 million people unemployed, which is more than the 1.2 million vacancies. We've got 700,000 youngsters who are so-called NEETs, not in education, employment or training, but we've also got these labour shortages. And this was not something that, I speak to Rishi Sunak reasonably often, and the time when he launched the furlough scheme, this was the last thing on his mind, the idea that we'd emerge from the pandemic with labour shortages. The furlough scheme was all about getting people through it, providing a bridge back to normality. Consumer confidence, we should set that against the fact there's a lot of money waiting to be spent in people's bank accounts. The so-called involuntary savings, involuntary because people couldn't spend on the things they normally spend on. It's between 150 and 200 billion pounds waiting to be spent. It won't all be spent at once. A lot of it is accumulated to older people who tend to spend at a slower rate than younger people. But that is there to be spent. Business investment, most of the surveys are pretty positive for business investment, but it hasn't kicked in yet, even though the Chancellor provided the incentive for it to kick in through the so-called super deduction scheme. So all these were the kind of, the way I would characterize 2021 was that it was a year of extremely strong statistical growth in the economy, roughly 7% economic growth in 2021. But it never, and that's the strongest since 1941. It didn't really feel like it. There was always the shadow of COVID. There were always the doubts about whether we'd get more restrictions and so on. So that's why it never really felt like a boom. It felt like a constrained boom in 2021. But I think there are, despite those slight worries over confidence, I think we should take the labour market as a very positive sign. The fact that employers have been employing people, the number of people on payrolls is 400,000 above pre-COVID levels. There's been a drop in self-employment, and some of those self-employed people may have found their way into employment, but this is still very strong. And the fact that firms have been willing and anxious to recruit is a good sign of confidence in the economy. So in terms of what firms have been doing, that is positive. Job vacancies very high at the moment. It's easier, as you all know, to advertise jobs now. I still remember with fondness, and so do our finance people, the days when the Sunday Times had a massive appointment section, often 24 pages, sometimes 32 pages of executive appointments. It was a great money spinner for the paper. But pretty much all of those have gone online now. It's easier to advertise jobs online and cheaper. And the only job ads we really get now are those for public appointments, which have to be advertised in a national newspaper as part of as one of the legal conditions. But so we miss that. But there are at the same time plenty of vacancies, plenty of shortages, as I say, and I think that is all positive. So I think this recovery does have plenty of legs. I mean, the OBR, which is the official forecaster, back in the end of October, predicted 6% growth for this year. I think forecasts have slightly come down since then to between 4 and 5%, but that's still extremely strong in terms of past behavior. So this is something where we've had a big drop in the economy, a big shrinkage in the economy in 2020, a good year in 2021, but tarnished by fears about COVID. Hopefully, this year will feel better in the sense that, you know, one would hope that fears about COVID subside. So 4 or 5% growth this year should feel better, I think, than 7% growth was last year. So I think that is a reason to be pretty positive about the growth outlook. And the question, if I can move on, you know, what about COVID? You know, good question. We obviously had very high Omicron numbers, but they're beginning to subside and subside quite quickly. And, you know, people blame the scientists quite often for getting their projections wrong. But I do remember that Chris Whitty said that the rise will be very, very pronounced and very sharp, but so should the fall be. And I think it looks as though he's been right about that. And so I think we're moving into this, you know, living with COVID because we didn't have the hospitalizations and deaths to the same degree as in previous waves. And you know all this. The government is talking, you know, all the time now about pandemic to endemic. You know, we have to live with this. And the hit to economic activity as a result of Omicron looks to be quite minor. So, and, you know, we've seen the restrictions lifted. I would be astonished if we were to see any further lockdowns. I think the politics is against it, but also, you know, the idea of living with it, treating it as endemic, you know, very much argues against any further lockdown. So I think we've put those behind us, which again, I think is a pretty positive thing. Let me move on, unless John's got any questions on that, on all that, which I don't think he has. Inflation, as I say, this is the story of the moment, rising very rapidly. You know, a year ago, inflation was negligible. Now, as I say, it's 5.4% or 7.5% if you prefer the RPI. And it is, as I wrote last Sunday, all around us. You know, you look at business costs and prices, material costs are going up, wage costs are going up to a certain extent. And, you know, and in response to that, you know, and every news item you see about this is about, you know, firms having to raise their prices because their costs are going up. So you know, and the danger here is that it becomes embedded in the system, that you don't just see a spike in inflation. We've had spikes in inflation before. We had 5% inflation in 2011. We had 5% inflation, you know, as the financial crisis was hitting in 2008. But none of those became embedded. The question is whether this one does, and I think that is the issue of the moment. You've seen this surge in natural gas prices, tailed off a bit, you know, towards the end of last year and the beginning of this year. But you know, the fact that prices were high throughout most of the autumn means that the energy price cap will go up by perhaps 40 or 50% in April, having risen a lot in October. So that, you know, and that probably guarantees that we'll see inflation of roughly 7%, you know, maybe 8 or 9% on RPI in April, and that also guarantees that there'll be a hit to real wages. So I think this is there are two questions about inflation. You know, the first is it going to come down again after rising very sharply in the first half of the year? And I think in balance it will come down, but it may not come down as much as the Bank of England hopes it will. I think we'll still be seeing 3 or 4% inflation in the first half of 2023. It will take, you know, maybe a couple of years before it gets anywhere near 2%. Maybe it will take a bit longer in the UK than elsewhere. And the result of that is that there will be a squeeze on incomes. Now, what does that squeeze mean? You know, does it mean people will be spending less? It could be, but you know, we've already seen some tentative evidence that as this squeeze on incomes has started, people have begun to borrow more. You know, so that is a fairly tried and trusted way of getting out of a squeeze on incomes. But also, you've got, as I mentioned a moment ago, that wall of involuntary savings ready to be spent. So I don't think we should be too pessimistic about the consequences of the squeeze on real incomes. Some people will be hit very hard by this, but I think on balance, it's not going to produce a collapse in consumer spending or a collapse in demand for housing. I think it will be something that people will try to see their way through it, perhaps by drawing on savings, perhaps by borrowing. But a squeeze it will be. And the second issue is whether inflation is longer lasting than I expect, and the Bank of England and others expect. And the question there is whether it feeds through into higher wages, whether you get a wage price spiral of the sort we used to have. And I just don't think the mechanism is there in the UK for that to happen. It used to happen because we had very powerful trade unions. It used to happen because the wage bargain was very important. Wages are determined differently now, and to the extent that you have wage settlements still, you do still have wage settlements. In general, they are pretty controlled and pretty low. I mean, the latest evidence is that wage settlements are averaging about 2.5%. I don't think people are suddenly seeing, in general, 5, 6, or 7% wage settlements. So, there are pockets, HGV drivers, some other people who are whose skills are in short supply are getting decent increases. People who change jobs are getting decent increases. But in general, I think wages are still pretty well anchored. So I think, the danger of us getting locked into ever and ever higher inflation because wages are going up and that adds to prices and so on is pretty low at the moment. So I think inflation will come down, maybe not as much as the Bank of England would like to see, but I think it will come back down again. Now, interest rates, this is the interest rate dog. It is a real dog, and I took this photo myself. It hasn't barked much recently. We were at, we've seen very limited interest rate changes, as you will know, since the financial crisis, and rates were at 0.1% from March 2020 until December, when the Bank of England, I think, having not raised rates in November because it was worried about what might happen to unemployment after the end of the furlough scheme, did so in December. And that was quite unusual because, raising interest rates in December is not something that the Bank of England has done since it was made independent in 1997. But also, that was the time when the Omicron wave was really raging and the case numbers were going up. So it didn't look ideal. But I think the fact that they did it in December showed their determination to try and get to grips with it, to show that they were reacting to high inflation. The December rate rise came after inflation had risen to 5.1%, since which time it's gone up to 5.4%. So I think that tells us that the rates are going to go up further. Even though the Bank of England still thinks inflation will drop, I think we will see further increase in interest rates this year. The first will probably come early next month in February the 3rd, I think the date is. And then we could easily see a rise every 3 months from then on. I don't think they're going to panic. I don't think we're going to see interest rates at the level that any of us would regard as remotely familiar. Official interest rates averaged 5% from the early 90s until the financial crisis. And even that, many of us regarded as very low because, rates averaged 12% in the 1980s. The peak for bank rate was 17% in the early 80s. Those days are not going to come back. The question will be, whether we get to 1.5%, 2%, which I think is possible over the next 2 or 3 years, but I think is probably also manageable. But this year, I think the prospect is, the question is whether we end the year at 0.75%, which is where we were before the pandemic, or 1%. But we should get used to the idea of rate rises coming through in a gradual way, because I think the bank will want to see it's responding to the inflation danger and is getting on top of it, even though, and the question may come up, even though many of the factors causing higher inflation are global in nature.
Can I ask a question there?
Please, John,
David, if I may. Obviously, as you said, I mean, you expect sort of inflation to take quite a while to come down, maybe being still 3 or 4% next year. And at the same time, obviously, you say interest rates end of this year around about 1% or maybe 0.75%. That is still a sort of negative interest rate in real terms of 3% or 4%, depending on where inflation peaks this year. And part of me thinks increasing rates to 1%, which is still considerably below inflation, is it going to have any impact? It's not really that a material tightening of monetary policy. It's really just going back to already where we were in 2018.
Yeah, you're quite right. And I think if you were looking at this in a historical perspective, you would say that the inflation becomes a real danger when real interest rates are allowed to be negative for too long, and that danger looked to be there. The period since the financial crisis, until the early part of 2009, bank rate, the official interest rate, had never been below 2%, and bank rate has been around since 1694 when the Bank of England came into being, and it's never been below 2% through wars, through past pandemics, through everything else. And since the early part of 2009, it's never been above 0.75%. And often during that period, it was most of the time during that period, real interest rates had been negative, and that did not let a lot of inflation back into the system. So the Bank of England's view on that, and these things are always there to be proven wrong, is that what they would call the R rate, which is the long-term sustainable interest rate, the interest rate that you need to keep inflation well anchored and under control, has itself come down. Many factors have pushed interest rates down, including demographics, including people's expectations of low inflation. But you don't really need an interest rate all that much more above 1%. To keep inflation under control. Now, I say that that is research done during a period where inflation has been under control. It has not yet been tested in a period of rising inflation, and it could be that when those things are revisited, they'll find they've made an almighty mistake. And that we went into this with low interest rates. The interest rate rises in prospect were never enough, and then you get into difficulty. The Office of Budget Responsibility, the official forecaster, did have a look at this in its last forecast and said, well, asking precisely your question, what happens if it doesn't work, if softly on interest rates, raising them to a level which is still very low, what happens if that doesn't bring inflation under control? And they ran an alternative scenario in which bank rate had to go up to only 3%. 3% would be regarded by many of us in the past as incredibly low, but and that was quite damaging for the economy, because mainly because we've all become so accustomed to very low interest rates, and so I think the question is there to be asked, and this is a test of it. This is a test of that idea that you don't, little touches on the interest rate tiller are enough to keep inflation under control, and they may not be. So it's a good question to ask, and a very fair one, I think. So we're into a real life experiment now, and if wages did follow through, if these supply shortages, many of which emanate from China, become a lasting thing and continue to push costs higher, as it's one thing to have a permanently higher level of prices. We may see that with energy, but they have to keep going up if inflation is going to continue to go higher. But it may be that these supply shortages are telling us something important about the way the global economy is working. One of the central banks are praised, including the Bank of England. Since 1997 and independence, inflation has averaged more or less exactly 2%. And a lot of it, people look at that and say, well, well done them. They've done a marvelous job in keeping inflation under control. But a lot of the low inflation of the past 25 or 30 years has been due to the impact of globalization. Globalization, the opening up of China and the ending of the breakup of the Soviet Union had the effect of bringing a whole load of workers onto the global market. Not necessarily those who migrate, but those whose supply is available to the world, and that brought down inflation, as did competition, as did the shift to lower cost locations. And if some of those things are going into reverse now, and the supply shortages are telling us that, then that could mean that the low inflation as a result of globalization could be coming to an end. And again, that would test assumptions about whether you can keep interest rates this low and keep inflation under control. But it's a very good question, and we'll know the answer. If we do one of these in a year's time, maybe we'll be close to the answer. But I think it is a very fair question. Shall I move on? I'll move on, John. I think you're muted. Yeah. So a third thing I wanted to ask was about tax and whether Rishi Sunak has raised enough in taxes. And, he may have had, more interest in recent days about what's happening next door at number 10. And I can only imagine that Rishi, who lives above the shop in Downing Street, must have witnessed some of these rowdy parties in the garden. But I don't think he ever went to any. But last year was, as I said earlier, an exceptional year for announcements of tax increases. On these first two here, it's a fair way of looking at what the Johnson government has done is to take what David Cameron and George Osborne regarded as their priorities and reverse them. So George Osborne was determined to get the lowest corporation tax rate in the G20 of major economies. And, as you may remember, corporation tax, the main rate of corporation tax was supposed to go down to 17% in 2019, but that was cancelled by Boris Johnson. It stayed at 19%, and now it's going to go up to 25% in April next year. Income tax allowances and thresholds, the policy of the Cameron and Osborne government was to raise those by more than inflation. And that helped. In a period where real wages were quite flat, if not falling, these gave people more take-home pay. So those were quite important. They're going to be frozen for 4 years from April. And when that decision was taken, I think the expectation in the Treasury was that inflation in April 2022 would be, maybe 3%, but certainly not 7%. So that will be quite a hit. National insurance is going up. So you add all those, again, 1.25 points on national insurance for both employers and employees. Quite a big hit, raising quite a lot of money. All of these added together, is one of the biggest tax increases, we've seen for very many years. This is really serious stuff in terms of higher taxes. And when you announce these things without any of them having been implemented, then you've got no time to assess the effects of one. Maybe you might have wanted to assess the effects of freezing the income tax allowances and thresholds, which brings more people into income tax, brings more people into the higher rate, before raising national insurance. But there'll be no time to do that because the two things happen together, and so on. So announcing is one thing, looking for the effects of it is another. But this was a big year for tax announcements. The aim, of course, is to keep debt under control. That there are two measures of government debt. One excludes the Bank of England. It doesn't exclude the QE, the quantitative easing that the Bank of England has done, but it excludes one or two other things, including the so-called term funding scheme. But on the main measure that we use, which is higher than this one on the chart, the public sector debt, national debt, is about 2.2 trillion. So it's close to 100% of GDP, 100% of the size of the economy. And before the pandemic, it was roughly 80%. So the effect of the pandemic has been to push up the sustained level of government debt by perhaps 400 or 500 million, by 20% of GDP. And that's quite a big hit. And Rishi Sunak is determined to keep that under control, to at least to have it falling, even though if only slightly, relative to the size of the economy by the end of this parliament. And he, of course, even before he knew how much trouble Boris Johnson was in, he had this unusual little coda in his budget speech. Unusual because he just announced, a series of increases in public expenditure, and behind him were all the announcements of the tax increases. But he also wanted to show that he was a tax cutter at heart, somebody who, when he has the aim, the means to cut taxes, he will do so. We want taxes to be going down, not up. So I think he's just putting that there as a statement. Maybe that will come in useful if there is a leadership contest in the Tory party, but we'll see about that. I think there are still some things that we knew that he wanted to do in response to the pandemic. That second one there, equalising the tax treatment of capital gains and income, that was something that was recommended by the government's own Office of Tax Simplification. I think he was warned off that by the outcry from entrepreneurs that would do a lot of damage. He talked quite early in the pandemic about bringing the tax treatment of employed and self-employed people into line, but the national insurance increases actually do the opposite of that. And, you have to think about green taxes, how, as a simple example of that, if we're all going to be gradually moving to electric vehicles, do you have to replace, petrol and diesel duty with road pricing, for example? What do you do about that? So, there are quite a few things there, but I don't think there's going to be any new tax hikes. I mean, there is a question, a budget has not been announced for March. An official forecast has been commissioned by the Treasury, but we may see a budget in March. We may have to wait till November, but I don't think at either of those points we'll see any new tax hikes. I think that is done now. He regards that as done. Politics argues strongly against it, but also the OBR suggested enough has been done to achieve the government's targets on the public finances. So I think we can relax on new tax hikes and just see how much of an impact the ones that have already been announced are. And that impact could be important and significant. Unless any questions on that, but I'll wait for the questions at the end. Let me just talk about the housing market briefly. As I said earlier, this was, 2021 was pretty extraordinary. The period since the spring of 2020 was extraordinary for the housing market. We saw the average UK house price spurt higher upwards. So house price inflation, even on the official measure produced by the ONS, is at 10%. And this was unexpected. Say normally if you have a recession, you have a fall in house prices. And many of you will remember that, the fall in, we had a mild recession in the early 90s, but a massive fall in house prices. We had a big recession during the financial crisis and a smaller fall in house prices, but a fall nonetheless. This time, the housing market barely paused for breath in response to the pandemic. And as I say, the annual percentage change in house prices, even on the official measure, is in double figures at the end of last year. And transactions in 2021 look to have been the highest since 2006 or 2007. So highest since before the financial crisis really hit, and that is, again, that is quite surprising. And some of you will be aware of that. There was obviously a fall in October at the end of the stamp duty holiday, but things recovered pretty quickly. Prices higher, activity higher. This has been a very strong housing market. And we know why that is. We know that, the fall in official interest rates, the cut in official interest rates to just 0.1% in March 2020 was important. It embedded very low mortgage rates, and mortgage availability, unlike during the financial crisis, is very strong at the moment. QE, more quantitative easing was done in response to the pandemic than in the previous 11 years that the policy had existed. That is also tends to be supportive for asset prices in general and house prices in particular. The stamp duty cut, we know about that. I suppose the stamp duty cut in July 2020 was, it was easy to see why the Chancellor did that. And he did it, I think, mainly with an eye. I mean, it's a popular thing to do, but mainly with an eye on keeping house building going during the pandemic, because I think his fear at that time was that the builders were, they were working on completing existing sites, but they weren't really developing any new ones. So I think the stamp duty cut was intended, as well as its general effects, to provide an incentive for the builders to carry on. Extended it in March last year. Many people were surprised by that. I wasn't so surprised because I think I know how his mind was working on that. And his mind was working in the sense that these things should be kept in place as long as there were restrictions, and there were restrictions in place in early March when it was extended. And of course, this phenomenon of working from home and people changing the way that their property priorities, many people deciding that even now, now as of today, the working from home advice has been lifted, but the hybrid model also allows people to work further from their workplaces and commute, than being in close commuting distance. So all those are important. And I think the other one was that a pretty deadly thing for the housing market is very high unemployment. But the furlough scheme, I think, took care of that and has continued to take care of that. The unemployment rate at the moment 4.1%, is barely higher than it was before the pandemic. So all those were very important to the housing market story in 2021. But I also don't think, and I'm not saying this just because I'm talking to you, you have an interest in the housing market and in property. I also think we shouldn't think that, all the support has suddenly been pulled away. The stamp duty holiday is gone, record low rates have gone and they're now on the rise. But I think it's still the case that, interest rates are going to be relatively low certainly in comparison with what we've had in the past. Taking John's point about whether the rate increases in prospect will be enough to kill the inflation beast, but even so, there's strong competition among lenders as well. So I think mortgage rates are going to remain pretty competitive, pretty low. The interesting thing about the post-stamp duty period was how quickly momentum re-established itself in terms of transactions, in terms of interest, in terms of activity. So I think all that is pretty positive. And I think the excess savings, they're there, they're a lot, and some of those have already found their way into deposits, particularly for first-time buyers. Many more will find their way into the housing market over the next 2 or 3 years. So I think that is a positive thing. Unemployment, I think it's going to stay low. And this working from home effect, I think, is a positive one, and I think that will last. I don't know whether I ended last year by reminding you of my SCIP index, which is my own favorite proprietary economic indicator, but I'll just update you on it. It's based on the number of builder SCIPs in my street, and I've been monitoring the SCIP index for years. It's when there are none at all, we're in recession or there's no growth. When there are two, the economy is growing in line with what economists would call trend growth, and when there are four, it's an unsustainable boom. And the SCIP index, I have to tell you, has been all over the place, during the period of the pandemic. At first, when the crisis hit, nobody knew what was going to happen, and people didn't commission building work. They didn't want builders around their houses during a pandemic. But then it revived very strongly in the second half of 2020, and we did see, occasionally 4, even 5 SCIPs in the street as people were having loft conversions done, conservatories built, other things done. So there was a strong revival. Then it fell back a little bit. It's been up and down. I can tell you at the moment, and if 2 is normal, there are 2 SCIPs in the street at the moment, which I think is, if it tells us that maybe not all is right in the world, but it's pretty close to it. I combine it these days just for interest with another indicator, which is the station car park indicator. About half a mile from where I live, there's a station car park which takes people into central London, and I've monitored that during the pandemic as well. During the first lockdown, there were only a handful of cars used to come to the car park. Normally, this car park is full to bursting, but it was less than 10% full in the early stages. Then it gradually started to come back, but probably no more than 30 or 40% full. It got back, towards the middle of last year. It got back to 70 or 80% full. Dropped back again with the new working from home restrictions, and I haven't monitored it today to see whether yesterday's announcements have made any difference. But I think things are coming back gradually. I haven't seen the car park full for a very long time. I doubt it will be for quite a long time. I think people have adapted to working from home. They're not going in every day, and I think that's going to be the new way of working, the new normal, if you like. But we'll see what happens. Thank you very much for listening.
Thank you very much, David. That was fantastic. I've got sort of slightly linked to this, actually, in terms of not just housing, but the broader economy as well. It's just, one of the things we saw last year is that certainly house price inflation and activity in London was not as strong as that outside of London. So, as a country, obviously, historically, often London has been the sort of driver of house price growth, whereas it seems that post-COVID, that hasn't been the case to the same degree, and some areas of London, house prices may have stayed flat. And I just wondered also, linked to that, obviously, we're going into a position where working from home or hybrid working is going to be more commonplace. Obviously, the Conservatives have this levelling up agenda. I just thought whether you think that dynamic is sort of longer term trend, or is it just a blip because people were looking for more space, and are we going to go back to a more London centric sort of driven economy, or has the levelling up agenda generally got legs?
Yeah, it's a very good question. I think the answer to that is that I think it's, London has, even pre-pandemic, the stamp duty changes and, particularly, some of those changes affecting foreign buyers did have an impact. And I think the pandemic had the effect of, closing London off for a lot of international buyers. So I think that was a big factor. But you write London off at your peril. I mean, it is, I think, as I always say about, you say about Brexit, the City of London will lose something as a result of Brexit, but it will still be easily the biggest financial centre in Europe, and it has lots of other strengths. It's a big diversified economy, and I think the London market, I don't know what your experience is, but it seems to me that the London market is starting to come back quite strongly. I mean, in the latest eServe Acadata house price index, which I tend to look at because it's based on land registry data, gets those figures a little bit ahead of the ONS. And they had London as the strongest house price growth region in the country. That it had moved ahead. London house prices are up something like, their measure is well below 10% house price growth nationally, but they had London as the leading region. So I think it is starting to come back. International interest, I think, is starting to perk up a bit. I mean, there is and to the extent that, I think the particular problem for London has been the problem of what happens when you don't have so many commuters, and and all those businesses that depend on that have suffered quite a lot. But they will adapt. The sandwich bars, the dry cleaners, and so on, and the restaurants. And I think London will have to adapt to that. But I think London has still got a lot of strength. It's for years and years you hear that for young people Manchester is the place, or Birmingham's the place, or somewhere else is the place. I come from near Birmingham, and I always wonder whether Birmingham can ever be the place. But you think about but it never really is. I mean, London is where young people still tend to come to pursue quite a lot of careers, and I think that's always going to be the case. London still has a massive problem of housing shortage, which has to be dealt with. But I'm very, very positive about London. And the other thing I'd say in response to your, and Rishi Sunak has been particularly prone to do this. I did a talk before the latest restrictions in Southampton, and they were very worried about the point you raised. Is everything all about Newcastle and Middlesbrough and Sunderland now, and nothing about the south? And is the focus shifting? Is the focus shifted from blue wall to red wall by the government? But it plainly hasn't. I mean, Rishi Sunak, when he goes on his trips, always manages to cite a bit of extra money going in somewhere as proof of the government's levelling up agenda. And the two examples within the last 2 or 3 weeks, one was in Newhaven and the other one was in Faversham in Kent, so neither of which are anywhere near the northeast. So I think levelling up, and we'll see what they say in their white paper, I think levelling up is shorthand for anything that anywhere in the country where we're spending money, we'll say that is part of the levelling up agenda, and you don't worry in the south, don't even worry in London, you're not going to miss out on this, So I think it's a bit more amorphous than you might expect.
Thanks. And you've given quite a sort of positive picture actually in terms of positive outlook for this year. There is, I suppose, a counterpoint, and obviously one of the things that, and I think the numbers are astounding in terms of actually what people's energy bills are going to, how much they're going to increase by in April, and at the same time, obviously, cost of other goods is going up. Wage inflation might lag inflation, and at the same time, obviously, there's those bans, the income tax bans are not moving either. I mean, is there a sort of worry where you get to the middle of the year, maybe a little bit higher interest rates as well, where actually there is a bit of a crunch on some part of the consumer market? I mean, because obviously there's savings has been built up, but there's a lot of households with minimal savings, if that, and obviously they'll be the ones that are hit most by, those additional £140 of energy, and that feeds through into potentially higher defaults, arrears in consumer loans, credit cards, etc., which has causes some pressure on the system. Is there an issue, an affordability issue that could spark something more material later in the year?
Yeah, no, absolutely. I think would you have announced these tax increases to come through in April this year, had you known that inflation was going to be 7% by then because of energy prices? And the answer to that is no, and that's why Rishi Sunak is under some pressure to delay them. And I think delaying them, it could happen, but the Treasury will be that ruins the plan, really. I mean, if the governments try and get tax increases out relatively early in the Parliament, delaying them until 2023 would be, the risk is, I think, and the risk is the markets would see that as they're not going to happen at all, but they are needed to fix the public finances. But you wouldn't have done it had you known that inflation is going to be 7%. I think there's going to be a hell of a crunch. And the way that people respond to it, I mean, politically, it's the big issue. Economically, in the spring, it's going to be the big issue as well. And it will be surprising if there is not a hit to retail sales at that time. There's not a hit to consumer spending, but I think it will be. It's a question of getting over the hump of inflation into something somewhat lower in the second half of the year. And once that happens, one thing I would say is that we tend to describe these things in terms of the annual hit, but for most people it's the monthly thing that hits them, initially, so, an £800 increase in your annual energy bill doesn't mean you're going to be paying £800 more in April. You're going to be paying £800 more over the course of the following 12 months. And that is slightly less painful, but it is nonetheless real, which I think is why the government probably has to do something for lower income households, and that will cost a bit. I think it is almost impossible for them not to step in and help out. People like us will complain, but we have to grin and bear it, really. But I think lower income households, there is going to be a real problem there of people being pushed into poverty, people, pensioners, the suspending the triple lock on the state pension. It was a sensible thing to do because clearly if you based it on the hugely distorted average earnings figures, then pensioners would have got what looked to be an unjustified increase, but the unjustified increase would have only taken them a little bit above where we now expect inflation to go. So it's I think there will have to be targeted help for lower income households, targeted help for pensioners to try and ease that. And for the rest of us, it's just a question of trying to get through it and beyond it. But I mean, it means that in a way that it means that we need, in terms of growth in the economy, we need investment to be a more important contributor than it has been for a while, to compensate for some of the weakness in consumer spending. Not an absolute fall in consumer spending, but perhaps slower growth than you'd get normally because of that hit. And so business investment needs to step up to the plate, if you like, to give us that overall 4 or 5% growth.
And then one final question, and slightly away from economics, which I think we've got to ask you around politics and Boris. I mean, obviously now it's highly possible, maybe some would say probable, that there'll be a sort of leadership election at some point this year, and we can debate where that might be. If that does happen, and let's assume if that does happen, there's a change of leader, which obviously may not be the case. Does that change anything from an economy point of view, or actually the Conservatives got such a large majority, it doesn't necessarily lead to the uncertainty of a general election? And then, obviously you mentioned you speak to Rishi a lot. Does policy materially change if someone like Rishi becomes Prime Minister, or Liz Truss, or Jeremy Hunt, or Sajid Javid, whoever it might be? And then finally, if you were a betting man, who would you put your money on in terms of the next leader?
Yeah, I think it's a good question. I mean, one of the things I've been looking at is the extent to which, if you look at what's been happening to sterling recently, it's actually been going up, even as Boris Johnson's difficulties have been increasing. Which suggests to you that they wouldn't, the markets would not mourn too heavily if he was forced out, if he was replaced by a less chaotic leader. But I think with Boris, who I've known for for very many years. I mean, I briefly used to work with him, and I know him pretty well. But I think what you see is what you get, and what you get with Boris is somebody whose attention to detail is dreadful, who probably the reason that when he's doing these Downing Street press conferences, everything has to be written down, about the new restrictions and so on, is that he wouldn't be able to reel them off unless he had them written down. He just doesn't. He's too lazy to devote time to do that. And the reason he went to the party and so on, probably other parties, is that he probably genuinely didn't believe that these were against the rules that he adopted. But on your question, I think what you see is what you get. I mean, what you have to remember is that none of these people, whether it's Rishi, who's very good, Liz Truss, Sajid Javid, others, somebody who would probably haven't mentioned, because it's never usually the favourite, the pre-leadership challenge favourite that wins. They lack the pizzazz and the star quality that Boris has. I mean, his ability to warm up a room, to warm up a conference hall, is unrivaled within the Tory party. So they would lose that, and there would be his replacement would be some kind of technocrat, really. And so the Tory party would gain on competence but lose on showmanship. I think it probably will happen. I think he's hanging on by a thread. He may have got away with it this week, but I think the wagons are circling, if that's the right expression. And so I think there probably will be a leadership contest. I think probably Rishi will win it. And the thing then is that we just have to remember how young and inexperienced he is. I mean, the first Chancellor to remind me how old I was getting and how young some of these were was George Osborne. I met him when he'd just been appointed Shadow Chancellor by Michael Howard in 2005. And I thought, he's just a kid, and Rishi, I've known quite well, he's around about 40, and he was a junior minister. He's a recent MP. He's obviously done pretty well as Chancellor, done pretty well in terms of doling out lots of pandemic money, but he's not a rounded politician yet. But I think he probably is the favourite, and I'd quite like to see how he gets on. I think it would be quite good to see him as Prime Minister. But I don't think he could ever. I mean, if people want, sometimes, as we saw with, briefly, not for long, John Major after Margaret Thatcher, sometimes people quite like the calmness after the storm, and maybe he would do quite well on that. But I think he was the one who's the quality candidate, if you like. But Sajid is also very good, and very good. Liz Truss, I'm not too sure about.
Well, thank you very much for the time, David. That was a fascinating hour. So thanks a lot, and thank you everyone else for dialing in and joining us. Until the next one.
Thank you, John.
Thanks.